There is a system operating quietly beneath the surface of global economics, one that most people never see clearly, but feel the effects of every single day. It does not announce itself with fanfare or declare its intentions openly. Instead, it works through the language of opportunity, development, and progress. Nations in need of financial support are offered loans, and those loans come wrapped in the kind of promises that sound almost too good to refuse. Infrastructure will be built, poverty will be reduced, economies will grow. The pitch is clean, professional, and deeply persuasive. But underneath that polished surface lies a mechanism that has kept entire nations locked in cycles of dependency for decades, sometimes generations. The mechanism is simple in design, but devastating in execution. Money flows in, conditions follow, and control quietly takes root. To understand how this works, you have to start at the beginning, with the debt itself. When a developing nation faces economic hardship, the options available to its government are limited. Raising taxes on an already struggling population is politically dangerous. Cutting essential services creates unrest. So governments turn outward, seeking loans from international financial institutions, foreign governments, or private creditors. The most prominent lenders in this space are institutions like the International Monetary Fund and the World Bank, both established after World War II with the stated mission of promoting global economic stability and development. On paper, the arrangement seems straightforward. A country borrows money, agrees to repay it with interest over time, and uses the funds to invest in its economy. But the terms attached to these loans are rarely straightforward. Interest rates, repayment schedules, and structural requirements are baked into the agreements in ways that can be extraordinarily difficult to navigate, especially for nations with fragile economies and limited institutional capacity. And here is where the first link in the chain is forged. The moment a nation signs a loan agreement, it has entered into a relationship that extends far beyond simple finance. It has accepted a framework, and within that framework, the lender holds enormous power. The conditions attached to international loans are known formally as conditionalities. They are presented as responsible lending practices, ways of ensuring that borrowed money is used effectively and that borrowing nations implement the reforms necessary to repay their debts. In theory, this sounds reasonable. In practice, the conditions often go far beyond financial management and reach deep into the sovereign decisions of the borrowing nation. Structural adjustment programs, which became widespread in the 1980s and 1990s, required countries to privatize state-owned enterprises, cut government spending on social programs, open their markets to foreign competition, and deregulate key industries. These were not gentle suggestions. They were requirements. Nations that refused or failed to comply risked losing access to further funding, triggering debt defaults, or facing economic isolation. The consequences of non-compliance were severe enough that most governments had little real choice but to accept. And so the conditions became a form of currency in themselves, a way for lenders to shape the economic and political landscape of borrowing nations without ever formally governing them. The sovereignty of the borrowing nation remained intact on paper, but in practice, critical decisions about how the country was run were being made in boardrooms and offices thousands of miles away. What makes this system so effective at maintaining dependency is the way debt compounds over time. A nation takes out a loan to address an immediate crisis. The conditions attached to that loan often require economic changes that, in the short term, cause significant pain. Privatization leads to job losses. Cuts to social spending reduce access to healthcare and education. Market liberalization floods local industries with foreign competition they cannot survive. The economy does not recover as promised. In fact, it often deteriorates further. And so the nation finds itself needing another loan. Each new loan comes with its own set of conditions, Each set of conditions reshapes the economy in ways that serve the lender's interests more than the borrower's, and the cycle deepens. This is not accidental. Critics, including former World Bank economists and independent researchers, have argued for years that the structure of these lending arrangements is designed, whether intentionally or through systemic bias, to keep developing nations in a state of perpetual financial need. When a country is always in debt, it is always negotiable. Its policies, its resources, its trade relationships, all of these become subject to external influence in ways that would be unthinkable for wealthier, financially independent nations. The genius of this system, if one can call it that, is that it achieves a level of control that previous generations of imperial powers could only dream of, and it does so without the messy, expensive, and politically unpopular business of military occupation. There are no soldiers required, no flags planted in foreign soil, no formal declarations of dominion. Instead, control is exercised through financial leverage, through the quiet power of being the entity that a struggling nation must come to when it needs help. This form of influence extends beyond economics. When a nation is dependent on external funding, its foreign policy tends to align with the interests of its creditors. Its votes in international bodies reflect the preferences of those who hold its debt. Its regulatory environment is shaped to attract and protect foreign investment rather than to serve its own citizens. The language used to describe all of this is always neutral, always technical. Fiscal responsibility, market efficiency, economic reform. But the outcomes tell a different story. Nations that have gone through decades of these lending arrangements often emerge with weakened public institutions, hollowed-out domestic industries, and populations that have seen little of the promised development. Meanwhile, the wealth generated by their resources and labor flows outward, servicing debts and generating returns for foreign investors. Not everyone has accepted this system without challenge. Over the decades, a number of governments have attempted to push back against the conditions attached to international lending with varying degrees of success. Some leaders have sought to renegotiate loan terms, arguing that the conditions imposed were incompatible with their nation's development needs. Others have attempted to build regional financial alternatives, creating institutions that might offer funding without the same strings attached. Ecuador, Argentina, and several African nations have at various points defaulted on or restructured their debts in ways that prioritize domestic needs over creditor demands. China's emergence as a major global lender has added a new dimension to this dynamic, offering an alternative source of funding that comes with its own set of conditions and strategic interests, challenging the dominance of Western-led institutions without necessarily offering a more equitable model. The resistance is real, but it operates against enormous structural disadvantages. Nations that challenge the system risk being cut off from the global financial networks they depend on to function. The cost of resistance is high, and the institutions that enforce the system are deeply entrenched. Understanding this system is the first step toward imagining something different. The debt conditions control cycle is not a law of nature. It is a set of choices embedded in institutions, agreements, and power structures that were built by human beings and can, in principle, be rebuilt differently. Advocates for reform have proposed a range of alternatives. Debt cancellation for the most heavily burdened nations would free up resources that currently flow out of struggling economies and allow governments to invest in their own people. Reform of the conditionality system would mean that loans come with genuine support rather than prescriptions that serve external interests. Greater representation for developing nations within international financial institutions would shift the balance of power in decision-making. None of these changes are simple, and none of them are likely to happen quickly. The interests that benefit from the current system are powerful and well organized. But the awareness of how the system works is growing. More people, more governments, and more economists are asking the questions that this system has long tried to avoid. Who does this arrangement actually serve? What would genuine development look like if it were designed by and for the people it claims to help? The answers to those questions are not yet written, but the fact that they are being asked, loudly and with increasing urgency, suggests that the chain, however strong it appears, is not unbreakable.